You know those free robo-advisors? They can actually cost you 25% more over 30 years compared to traditional options, even with seemingly lower advisory fees. That's right, a quarter of your potential wealth, gone, silently eaten by costs you might not even realize exist in 2026. We're all chasing efficiency and low fees, especially with AI-powered investing, but the reality is these platforms often come with an intricate web of hidden charges. We're talking everything from embedded fund fees to spread costs you barely see. This isn't about whether AI investing is good or bad, it's about understanding the true price tag. We'll break down exactly how these invisible costs stack up and compare them to what a human advisor might actually cost. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Did you know that some free robo-advisors actually cost you more in lost returns than a traditional human advisor charging 1%? It's true. While these platforms often advertise expense ratios as low as 0.25%, many don't disclose the hidden fees embedded in the ETFs they select, often pushing the actual total cost closer to 0.75% or even higher. This isn't just theoretical. For someone investing $500 a month over 30 years, that seemingly small difference could mean sacrificing over $100,000 in potential gains. We're going to dig into how these platforms operate, looking at the fine print of firms like Betterment and Wealthfront. We'll explore the often overlooked trading costs, rebalancing fees, and even the tax implications that can silently erode your portfolio. This isn't about saying AI investing is bad, it's about understanding the full picture, especially as the market shifts and the promise of set it and forget it clashes with the reality of performance. The lesson here is that transparency around fees matters, now more than ever, as every basis point counts towards your long-term wealth. But what exactly makes these free platforms so appealing, and how do they initially hook new investors? It turns out, many of these platforms, like Charles Schwab's Intelligent Portfolios and Vanguard Digital Advisor, lure you in with a deceptively simple promise: zero advisory fees or no annual fees. Imagine you're a new investor, perhaps a Gen Z graduate just starting their career with a modest $5,000, and you're bombarded with ads in 2024 across social media and financial news sites. These platforms promise automated investing without the hefty 1% to 1.5% management fees that traditional human advisors, like those at Merrill Lynch or Morgan Stanley, often charge. It sounds like a dream come true, right? Simplicity, sophisticated automation powered by algorithms, and the perception of democratized, low-cost investing, it's a powerfully attractive combination. These early robo-advisors truly rose to prominence as disruptive innovators, threatening to completely upend the traditional financial advice industry. They came onto the scene promising to cut out those expensive assets under management (AUM) fees, which for a $100,000 portfolio could mean saving $1,000 to $1,500 a year right off the bat, money that compounds significantly over decades. And to be fair, they do offer some genuine, tangible benefits. Automated rebalancing, for example, is a real time saver, intelligently keeping your portfolio aligned with your target asset allocation and risk tolerance without you lifting a finger. Plus, their low minimums, sometimes as little as $3,000 to start for Schwab or $5,000 for Vanguard, make investing accessible to a much broader audience, including those historically priced out of traditional financial planning. But here's the kicker. If they're not charging explicit advisory fees, how do these multi-billion-dollar companies make money? And where do those hidden costs come from that can surreptitiously eat away a quarter of your wealth over time, silently eroding your long-term returns? Did you know that some of these free platforms actually keep up to 30% of your money in uninvested cash? This isn't just a small oversight, it's one of the biggest hidden costs, a phenomenon known as cash drag. Take Charles Schwab's Intelligent Portfolios, a platform famous for its zero advisory fees. While it sounds great on paper, their typical balanced portfolios can hold anywhere from 6% to 10% of a client's assets in cash. For someone with a more conservative allocation, that cash holding can balloon to as high as 30%. Now, where does this cash sit? It's usually held at the advisor's own bank, in Schwab's case, Schwab Bank. And here's the kicker. This cash earns minimal, or sometimes even zero, interest for you, the client. Think about that. If you have $100,000 invested with Schwab Intelligent Portfolios and 10% of that is held in cash, that's $10,000 sitting idle. The real problem here is the opportunity cost. That $10,000 isn't just sitting there, it's missing out on potential market returns. In a year where the S&P 500 returns, say, 10%, the $10,000 could have generated an additional $1,000 in growth. Over decades, this cash drag silently erodes your potential wealth. For example, in the bull market from 2010 to 2020, missing out on even a modest 7% annual return on 10% of your portfolio would have had a substantial impact. The lesson here is that a zero fee might just be a camouflage for another way they're profiting from your money. So, what exactly does this uninvested cash cost you over the long run, and how much wealth could you be leaving on the table? But here's the kicker. That uninvested cash isn't just sitting there, it's actively costing you, big time. We're talking about what economists and financial strategists like Dr. Jason Zweig referred to as cash drag, and its impact on your portfolio can be shockingly similar to explicit advisory fees you'd pay a human advisor. For a diversified portfolio designed to track a broad market index like the S&P 500, a typical 6% to 10% cash allocation, often held for rebalancing or liquidity, can create an annual return drag of between 0.3% and 0.5%. Let's put that into perspective. Imagine an investor, let's call her Sarah Chen, who allocates $100,000 to one of these free platforms, expecting market returns. Over 20 years, if her portfolio consistently suffers from a 0.4% cash drag annually due to uninvested balances, that seemingly small percentage could cost her anywhere from $30,000 to $50,000 in lost returns. That's money that never even had the chance to compound, growing into a potentially life-changing sum. Consider this. A hidden, unstated cost that rivals the 0.5% to 1% annual management fees charged by many traditional financial advisors at firms like Fidelity or Charles Schwab. The insidious part? You'll never see cash drag explicitly listed on a monthly statement or annual report. It's an opportunity cost, a silent killer of wealth, completely invisible to the untrained eye, lurking in the fine print or the absence of investment. The lesson here is that a free service can very quickly become one of the most expensive decisions for your long-term wealth, not through explicit fees, but through the cost of doing nothing with your money. So, if these platforms are intentionally holding significant amounts of cash, and it's clearly not for your optimal benefit, whose benefit is it for? But what if the free platform is subtly steering you toward their own, potentially suboptimal, investments? This is the core of the proprietary problem. It's a second layer of hidden cost, often unseen by new investors. The use of proprietary ETFs and funds by many robo-advisors. While platforms might boast about low expense ratios, say 0.03% to 0.07%, these aren't always the absolute lowest cost or most efficient options available across the entire market. Take Vanguard Digital Advisor as a prime example. While lauded for its low costs, the platform primarily invests client money in Vanguard's own suite of ETFs. Now, Vanguard ETFs are excellent, often industry leaders in terms of low expense ratios, like the Vanguard Total Stock Market ETF, VTI, with its 0.03% expense ratio. But are they always the only option? Or necessarily superior to every alternative out there? Not always. For instance, an investor might find a similar exposure with an iShares ETF that has an identical or marginally lower expense ratio, or one with slightly better tax efficiency for their specific situation. The conflict of interest here is subtle but significant. The robo-advisor benefits by keeping your assets within its own ecosystem. Even if a third-party ETF offers a marginally better performance, a slightly lower expense ratio, or even just a better fit for a specific tax strategy, the proprietary platform has a built-in incentive to direct you to their own product. It's like a car dealership only selling you their brand's tires, even if a competitor's set might be a fraction cheaper or perform slightly better for your model. The lesson here is that free often comes with strings attached, limiting your choices to what's most profitable for the platform, not necessarily what's best for your portfolio. So, if these platforms are free and invest your money in their own low-cost funds, how do they actually make money? But what if all these free features actually ended up costing you more than a human advisor charging a 0.5% fee? It sounds counterintuitive, but for many new investors, this is exactly what happens. When you combine the implicit cash drag from uninvested funds with the subtle cost differences of proprietary ETFs, a free robo-advisor can quickly become pricier than a traditional human advisor. Let's break it down. We've seen how cash drag can quietly siphon off 0.3% to 0.5% of your portfolio's potential annual return. Now, add to that the small but significant difference in expense ratios if your free platform uses proprietary ETFs. While a broad market S&P 500 ETF from Vanguard, like VOO, might charge a 0.03% expense ratio, a comparable proprietary fund from a robo-advisor might be 0.05% or 0.07%. That extra 0.02% to 0.04% might seem tiny, but over decades, on a growing portfolio, it compounds. Consider a Gen Z investor, let's call her Maya, with a $10,000 portfolio. If her free robo-advisor holds 6% in cash and uses proprietary ETFs with a 0.04% higher expense ratio, that's an implicit cost of around 0.35% from cash drag, based on a typical 6% allocation costing 0.3% to 0.5% of total portfolio value, plus the 0.04% ETF difference. Suddenly, Maya is paying an effective annual fee of around 0.39%, all without seeing a single line item charge. When you compare that to a human advisor charging a transparent 0.5% AUM fee, who might offer tailored advice and broader investment options, the free service starts to look like the more expensive, less valuable option. The lesson here is profound. A free service that costs you 0.3% to 0.5% in lost returns, restricts your investment choices, and provides no personalized guidance, often delivers less value than a moderately priced, transparent human advisor. Always look beyond free. What seems like a cost saver can be a wealth destroyer, especially when the bill is hidden in plain sight. Before entrusting your money to any platform, especially one promising no explicit charges, calculate the true opportunity cost and implicit fees. So, the lesson here is that in the world of investing, free is rarely truly free. It's often a marketing illusion, a way to obscure significant, implicit costs that can quietly erode your returns. We saw how cash drag from uninvested funds and the subtle difference in expense ratios from proprietary ETFs can add up, making a free robo-advisor potentially more expensive than a human advisor charging a 0.5% fee. What this means for someone looking to optimize their investing strategy is the necessity of scrutinizing not just explicit advisory fees, but also the implicit costs of lost opportunity and restricted choice. Have you ever looked closely at the holdings in your free robo-advisor account and noticed the fees on the underlying funds, or the cash sitting uninvested? Share your experience in the comments below. If understanding the hidden mechanics of your investments helps you make smarter choices, hit that subscribe button for more breakdowns that show you the math behind the money. And if you're wondering how to actually build a truly diversified, low-cost portfolio yourself, my deep dive into building an ETF-based portfolio for under 0.05% in fees is exactly the next video you should watch.